Good afternoon, everyone. I'm very excited to welcome in today's discussion Kalpen Parkh. Let me take a few minutes to introduce him. Kalpen Parkh is the president of DSP Investment Managers. He's a member of the executive committee at DSP Mutual Fund. Uh, Prior to this, he was the managing director and the head of sales and marketing at IDFC Mutual Fund. Kalpen has worked in leadership roles across the industry for 2 decades. And more than anything, he's really, really passionate about investing in mutual funds. And any of you who followed him on Twitter would probably know this. So, welcome to the show, Kalpen.
Thank you, Adil. Very happy to be part of this show and nice talking to all your viewers.
So, my first question, right, and I have a 2-year-old daughter. I see that you're teaching your son about investing and SIPs on Twitter. So, tell us a little bit about what you're trying to do.
So actually, I'm not trying to teach him. I'm just trying to spend more time with him and talking to him stuff that he doesn't understand sometimes makes him come closer to me. So that's my vested interest. Having said that, I do feel that the biggest ingredient in good investing and wealth creation is not returns. Is not knowing what will markets do. It's primarily time, because in the formula of compounding, time has exponential value, return has addition value, and the principal has multiplication value. So the biggest variable is time. Now, who has maximum time in life? Ideally, people who are young. So Warren Buffett once had said that I started investing at the age of 11, and I repent that I was 11 years late. So that's exactly why I feel that parents should definitely encourage their kids to start learning about investing early, because you always say start early, but how do you start early unless you don't explain? And let's say, did my first investment when I was 26, 27, when I joined a mutual fund. Had I not worked in a mutual fund, I would have invested much later. So we lose the biggest ingredient, which is time, because of lack of awareness. And we invest very tactically for 2 years, 3 years. Right now equity is doing well, so let's put in equity. Gold is doing well, for 2 years, put in gold. That's not the game. The real game is for how long is your money in productive asset classes, and the longer it is. Recently Morgan Housel made a very, very interesting blog in which these three lines were like shocking. He said that if Warren Buffett was the richest man on earth, and let's say his entire wealth today is $100, if he had started only 20 years late, his wealth would have been $1. So 99% of his wealth is not only on account of his 17-18% dollar returns. It is also because his money is compounded over roughly around 79 years. So instead of 79 years, had it compounded for 59 years, the total wealth would have been 99% lower than what it is today. Even his 1% wealth is very large. But the point I want to stress upon is time is your real superhero in the journey of investing. And that's what I try to, and I ask this question that I can't now teach myself the concept of time. I can only teach a younger kid. So hence my son becomes my guinea pig.
That's great. I've heard that parents should talk to children about what they're passionate about. And since you're passionate about investing, that becomes a real connector. So let me dive into my first question. Now, if you have a range of funds out there, even with DSP Mutual Fund, you have several funds. In these times of COVID, right? If investors thinking about how to pick a fund, can you tell us one or two things they should use to judge which fund, equity fund, they need to get into amidst this COVID time?
See, I think COVID, to be very honest, Adil, I was very overwhelmed when I was told that the topic is to build a COVID-proof portfolio. So I was reflecting that, we are not able to protect ourselves from COVID. I had many, family members who detected positive and had to go through medication. So if I can't protect family from COVID, can I really protect portfolios from COVID? It's very ironical that you asked me the same question. It's a difficult question. The point I have is that COVID is an event, and the event has implications which are not completely known to us. So many times when there is uncertainty in the market, that uncertainty gets reflected in lower prices. Now, ironically, or unusually, even in a crisis today, asset classes are not reflecting that we are in a crisis. Asset classes are behaving as if there is no COVID, as if the world has found an answer to COVID. So I feel that today I'm operating with incomplete information of the future. I don't know what are going to be the level 2 effects of COVID. Level 1, we all know now that it's a health scare. It is going to last for some time. No one knows when is the vaccine going to come. No one knows when is herd immunity going to come. Lockdowns have started and stopped in some countries and restarted again. In India also, we are having one step forward, two step behind with lockdowns. Economic growth is at a low we've never seen before. So there are bad news, but stock prices are behaving as if there are no bad news. They continue to rise, and this also is a reflection that stock prices don't have to always reflect fundamentals or the real economic health. Stock prices can have, markets can have a mind of their own because they are also driven by liquidity, they are driven by low interest rates. So in my view, what I would do is I would diversify my portfolio. I will invest across multiple asset classes because I'm starting by making a statement. I don't know the future, at least in the near term. See, in the long term, odds are always in your favor that 100% of times equity as an asset class has done well if your time horizons are 10, 20, 30 years. But in the near term, which is 1 year, 3 year, 5 year, there are periods when fixed income does better than equity, when gold does better than equity. So if you are a very long term investor, then stick to an equity fund. That's good enough for you. And if you're an investor who's going to get worried with near term volatility, I feel markets will fluctuate. That's a universal rule of markets. That's a universal rule of nature. Nature fluctuates, seasons fluctuate, day and night. Stock prices will also fluctuate. Returns will also go up and down. So right now we are at the high of a cycle over the last few years. We are at a cycle high from a market return point of view. We will have phases of slow returns, no returns, negative returns, and again the cycle will turn. So personally, I have my portfolio broadly split as 50 rupees in equity, almost 35 rupees in fixed income, and 15 rupees in global funds, which invest in global stocks as well as gold stocks, gold mining companies. So it's a breakup. One can say it's a confused portfolio. It does not have clarity. It does not have conviction. But truly speaking, I don't have conviction right now on the near term. I do have conviction in the long term. My equity portfolio will do very well. I'm a slightly conservative investor, so I always keep at least 25 to 30% in debt in my portfolio. That's my profile. But I don't want you to assume that this is the best portfolio profile. Personal finance is more personal and less finance. So each investor has to, ask question that what type of an investor am I? What type of, can I see through short-term fluctuations? Then let equity be a large part of your portfolio. If you want, less volatility in your portfolio, then start adding a little bit of fixed income to your portfolio. And that's the way to really plan. So in today's world, I feel always good to have some amount of debt as a cushion, keeping in mind that over the next 1 or 2 years, as we see the aftershocks of COVID, level 2 effects of COVID world over, as we see interest rates normalizing again from their closer to zero levels, there could be some volatility, and that part of debt can be useful as a cushion. So you need accelerator, which is equity, but you also need brakes at times to slow down for your car not to meet with an accident. And hence a combination is good. But if you were to say that, tell me only one fund, if someone says that, ye sab mat batao, just give me one fund, I would say a simple, asset allocation fund, dynamic asset allocation fund is the best answer for someone who wants to just put money in one fund and forget.
Okay, that is an interesting answer. So, we are always taught, Kalpen, to look at a fund performance versus the market benchmark. Yet, right, a couple of weeks ago, you put out a tweet saying that you've invested in a fund that has single-digit return over 5 years. Tell us what you're thinking.
Okay, so that's more a personal sort of portfolio. I have 5 or 10% of the portfolio where I do take slightly higher amount of risk because I'm very close to certain themes and trends and what's happening. I won't encourage that for a wider audience like this. But the point I was trying to make is that for your portfolio to do well over a long period of time, it's important that everything in the portfolio today should not be the best performing funds of today or the best performing asset classes of today. And the reason for this is to step one step behind and ask that or recognize that the biggest principle in investing is fluctuation. So markets fluctuate, asset classes fluctuate, and hence returns also fluctuate. So, if you're going to buy any fund which is at the peak of its return, whenever that fluctuation plays out, it will obviously show lower returns. So and hence it is important to also buy some asset classes or funds which are at the bottom of its cycle or somewhere in between of its cycle, so that in the next round when the cycle turns in its favor, you get advantage of that. So it's a combination. Like for example, when a cricket team is being built, you always have a combination of a great opening batsman, a great middle order, a good wicket keeper, a few very fast bowlers, and great spinners. It's a combination. Now, all of them are not like the fastest bowlers. So speed is not the only dimension. You also look for thoughtful spinners. You don't need only guys who can hit fours and sixes, but you need some good defenders also. So your portfolios, I always feel that the portfolio should be a good balance of defense and attack. And I generally believe I have been wired to. I have learned to be. I've been taught to invest in the underperformers of today. If you want the performers of tomorrow, you need the underperformers of today. And um, it comes from a slightly different philosophical thought that 99% of the world doesn't have money. That's the design of nature. Only 1% people really have enough wealth. So which means the pattern of investing has to be the way minority invest. Only less investors are always successful. And investors who are generally successful are the ones who don't get worried about recent underperformance. So most of us have this habit of saying that, okay, let me look at the Excel sheet, which fund is the best performing fund in the last 1 year, 3 year, 5 year. Now, 3 years back, which was my most underperforming fund, it was the World Gold Fund, very volatile. Today, it is the best performing fund. Now, today, we are getting a lot of people wanting to invest in that, but that performance has already played out. So it's very important to understand that some part of your portfolio is buying cyclicality. And when will the cycle turn? Are you closer to the turn of the cycle? Are you at the peak of a cycle? Like again, 3 years back, the most popular fund in our bouquet was the DSP Micro Cap Fund. Then today it's called the DSP Small Cap Fund. In 2017-18, we had queues lining up outside on our website where people wanted to invest, but we shut the fund because prices are very high. After 3 years, when prices have fallen by 40%, we have opened the fund, but no one wants to invest. But people need to understand, why is the fund manager closing the fund? Why is the fund manager saying no to money? Why is he being less greedy and saying don't give me money? There must be a reason. But the average investor starts getting affected by scarcity premium and says that, okay, if it's shutting, let me put my money. The way to think is, if it's shutting, it means the fund is saying this fund could be not the best fund for the time being. So go slow there. And now when the fund is open, so all I'm saying is, most people like to chase past performance. I like to chase future performance. I have learned from a lot of successful investors to look for future performance, because performance is cyclical. Now, if you accept the fact that performance is cyclical, then why buy peak performance? You rather buy cycle low performance and take advantage of the turn.
Fair enough. So you said in COVID you hold 50% in equity. If I was to, you would diversify the equity funds, but if pushed to a wall, you would go with a dynamic asset allocation fund. Let's now talk about the second 30%, which you said you hold in debt mutual fund, right? How do you select, if I was to push you to a wall, the one factor basis which to decide which debt fund is right for you amidst COVID?
So in fixed income, see, a lot depends on prevailing interest rates. What is the objective of fixed income? Largely preserve capital and earn whatever is the prevailing rate of interest. So interest rates in India today are somewhere between 5 to 7%. So if you invest in fixed income, roughly that is the band of return you will make over the next 3 to 5 years. But more importantly, if there is a sharp correction in the market, then this fixed income can help you, take advantage of that. Now, my way of choosing a fixed income fund is, there are again, different parts of the yield curve. Slightly technical language, I try to simplify it. The yield curve in India is steep, which means, if you invest in 3 months, 6 months, 1 year bonds, you will earn roughly around 4% return today. But instead, if you invest in 2 year and 5 year bonds, 2 to 3 year bonds, instead of 4, you will earn around 6% return, 5.5 to 6. So you have a huge spread. On a base of 4, you have a spread of around 2% more, 50% extra return, just by extending your maturity to 2 and 3 years. On the other hand, if you buy 5 year, 7 year, 20 year bonds, it gives the same return as what the 3 year bond gives you. So when you plot the yield curve, the sweet spot somewhere is at around 2 to 3 years. That has been the pattern of the yield curve in India almost for long periods of time. So we call this a steep yield curve. Wherever the steepness ends is where you build your portfolio. Typically, the portfolios which capture that steepness in the best way are short-term funds. So almost 80% of my debt money is in our short-term fund. Again, so if you were to say that tell me only one fund, I would say the short-term fund is the sweetest spot because it does not have long duration bonds. So if interest rates were to rise, long duration bonds prices will fall, NAVs could fall, but the short duration funds can minimize that volatility, and at the same time they have that extra excess yield over the 1 year bond or the 6 month bond. So it's a sweet spot. The short term funds have always done the best in India over a 20-year period, adjusted for volatility. So I feel, and to some extent, short term funds are closer to I'm using the word closer to, not exactly similar to fixed deposits, because when you buy fixed deposits, typically they are of 3 year tenor. When you buy company deposits, they are again of 3 year tenor. So on an average, 2 to 3 year is the tenor which Indian investors are most used to. Short-term fund gives you a similar sort of profile and experience to the investor.
Yeah, fair enough. I think we did a consumer paper which showed that we know if when you hold debt mutual fund for 3 years, that there's a even liquid debt fund, there's a 1.4% per annum advantage if you hold it for 3 years over an FD, both being at 6%. Now, automatically the follow-on question, right? And thanks for the direct answer saying if pushed to a wall, you would go with the short-term fund. The issues we saw with what happened with Franklin, are they past us? Does anyone need to be concerned when it comes to debt mutual funds on that particular front, Kalpen?
See, I think investors should always be sure of what they are investing in. A lot of Franklin funds were credit funds, so they had credit risk, and investors got advantage of that over 5 6 years where they earned excess return. This was a cycle where credit challenges in the economy emerged, and there were a lot of liquidity issues, and COVID fast tracked that because of COVID lockdowns, moratoriums. A lot of lending in the entire economy slowed down. So relatively tier two companies or weaker companies would tend to suffer. So to that extent, what happened to Franklin funds is something that has happened to most credit funds to a large extent. Franklin had a larger, pool of assets, and to give some credit to them, they are doing their best to, resolve this in the most investor-friendly way. It has created a little bit of anxiety that the fund has suddenly stopped redemptions. What happens to my money? But I think they are doing a decent job to get that money back. I think those issues are behind us. And remember, the mutual fund industry has around 15 lakh crores roughly of debt mutual funds. These entire credit issues that have happened has happened on the size of all credit funds put together today is only 30,000 crores. 30,000 crores on a base of 15 lakh crores. The balance 14.5 lakh crores has smoothly managed investor expectations, investor returns, investor inflows and outflows on a daily basis over the last 20 years now. I have been an investor in debt funds for almost now 21 years. A lot of people tell me that your debt time horizon is more than equity time horizon, and I have earned closer to double-digit return a lot of times in fixed income as well. So I would just tell investors, I think the panic is behind us. A reasonable, support and very very responsible reaction from regulators, from AMFI, from all mutual funds which came together to calm the nerves and say that yes, some accidents have happened. And remember, accidents happen in every economy. Even banks have gone through credit challenges. So to expect mutual funds will not go through credit challenges is unfair. Having said that, it is our responsibility to minimize credit accidents and ensure that our risk management and evaluation of securities is impeccable because investors are giving their hard-earned money meant for safety. So debt funds have to be more responsible, more prudent in terms of the risk we take. Now, when we manage money with very high emphasis on risk, obviously the returns are lower. What happens when returns are lower? Investors don't like it. In search of that extra 1 or 2 or 3% return, we start going into a risky category. When the risky category blows up, then there is lack of confidence again. It's a vicious circle. I think everyone has to play their role of being prudent, being less greedy, and being more disciplined, and and managing portfolios accordingly. But I would just tell investors that large pools of fixed income AUMs are money is allocated to government of India bonds, public sector companies, high quality bonds of big lending institutions, big corporates. So I won't say that you should worry about with the issue that happened. But can similar credit issues happen again? Every 5 6 years, whenever there is a credit cycle in the economy, credit issues will happen. Some funds will be able to navigate better, some will not be able to navigate better. Here is where investors have to also choose that if I don't want to fall into that trap 5 years later, then not let me not fall into the trap of chasing the highest returns today. One more reason why I don't seek the highest return is because highest return does not come free of cost. It comes with some amount of cost, which is risk, which is not visible today, but which gets manifested tomorrow. So being clear of what you're buying is very important. I'll tell you on our website, a lot of whenever investors come for the best performing funds, many times we get thematic funds. Our world gold fund, our world mining fund, our healthcare fund. These are the funds which are top of the charts right now because last 1 year they have done very well. But we've actually put a block in between, a very, very big black color box to say that, guys, these are thematic funds. Are you sure why you want to buy them? Are you buying them because the last 1 year return is good? But remember, 5 years back, they actually gave huge negative returns also. So be aware of your risk. So I think investors will do great service to themselves if they look for risk first and not returns first. And we as mutual funds also have to play that role of responsibility of educating and talking a lot more on risk and lot less on returns. Because returns, honestly, no one knows what returns I would do in the next 10 years. It's like, if you ask me, Kalpen, that next 10 years, what is going to be your weight? I have no idea. My intention will be that, okay, I don't put on a lot of weight, but I can't tell you with certainty. So returns are like that. I just want investors to realize that returns will remain unpredictable. What you have seen in the last 10 years is not necessarily you'll get the same returns in the next 10 years. There is no certainty. You know, in the first standard, if I were to ask anyone that what is going to be your score in the 10th standard, would anyone say no? What we know is that what is going to be my process of studying. I'll ensure that I study well, I give my exams well. But what marks will I get? I have no idea. And I think that's what people need to keep in mind while choosing whether a debt fund or an equity fund.
Fair enough. I think you're comfortable with short-term debt funds. I think that's a straight answer, appreciated. Now, you have a 12-year-old son, I have a 2-year-old daughter. I think one of the biggest things we're thinking of is, and having heart attacks is the cost of education. I just found out what a pre-nursery annual cost is, and it gave me a mild heart attack. If we're thinking about COVID-proofing this education fund, all of us should be building, right? How do we approach it, Kalpen?
Okay. So, as kids grow, see, India is a country of inflation, notwithstanding the last 2 3 years. So, education itself has a very high rate of inflation because the cost of education keeps going up. Uh, I'm assuming with this whole digitization due to COVID, cost of great education online starts coming down. I keep telling my son that you're not going to school anymore. You're using my laptop. I have spent money on that. Yet I have to pay the same amount of fees. Your school should give me some discount. But someday the cost of education should come down because of online delivery. But keeping that aside, the bigger point is that India is an inflationary country. So every year, let's say, the cost of inflation in India, lifestyle inflation is roughly 8 to 10%. So if our portfolio, just remains as it is, our 100 rupees will roughly become 92 rupees 1 year down the line in terms of its purchasing power. 92 will become 84 in the next year. So purchasing power is only going to go down for all of us. Hence, it is important to invest in such a way that we can increase our purchasing power. Forget increasing, we can retain our purchasing power. So the objective of investing is not that because this government has come and hence I'll make money, let me invest. The biggest reason to invest is to beat inflation. We try to invest to beat benchmarks, to beat other funds, to beat ABC mutual fund or XYZ scheme. I think they are more irrelevant objectives to have. The larger objective is to beat inflation. Now, today, if you say that I want my kids to, over time, go to the best school or college, and you Google the best schools in the world, I don't think in the top 50 also any Indian school will probably come. More often, they are all global schools, and the cost of education is crazy there. it's important we recognize that and start from today, that if 10 years from now or 20 years from now I have to spend few crores on my kids education, how do I prepare for it? And the only asset class which has purchasing power, which can retain purchasing power, is equities of good companies, stocks of good companies. So companies which will continue to grow their revenues, companies which are able to generate a significantly high rate of return, where the return on capital is 2 to 3 times of the cost of capital. Cost of capital in India is around 7% or 8%.
Hi, Kalpen, can you hear me? So I think we just lost Kalpen's connection. So let's give him a couple of minutes and
Blend of
see
debt
if.
will help you. Am I visible and audible?
Yeah, I lost you for the last 20
Oh,
seconds.
sorry.
But
Sorry, can I
can you?
repeat?
Yes, please
I'll
go.
repeat. So, like I said, an average middle class investor in India has to worry about cost of inflation, cost of capital, and asset classes which have a track record of beating inflation over long periods of time is equity. But the operating word is long periods of time. So, investors have to build 20-year, 30-year, or 15-year portfolios with dominant chunk in equity as an asset class, which will help them make their portfolios, able to beat inflation and high cost of lifestyle, which will emerge over a period of time. So equity has to be a very dominant part of any portfolio, and some amount of debt as a cushion, which can help you navigate ups and downs in between. So a lot depends on your time horizon. So if your time horizons are 3 to 5 years, short-term fund is the right answer. If it is 5 to 7 years, dynamic asset allocation fund is the right answer. 10 years and above, equity fund is the right answer. That's a very simple template to really look for.
Super. So I think 10 years and above, if you're saving for a kid who needs it, equity fund makes a
Absolutely.
lot of sense in COVID. So that's super useful. So now I have a couple of user Q&A, and I'm going to, and these are pretty detailed questions, Kalpin, but maybe you can
Yeah.
just give 30-second summaries for each of them. So the two Q&A are as follows. So one, the big benefit of debt mutual fund holding it 3 years, right, is you pay short-term capital gains. So the question is, how do you keep track of when you bought, when you sold, what was the interest, and file this properly when tax season comes up this year? Is there any easy way to understand, or someone who can, mutual fund house can help you with calculating tax on your mutual fund sale? And the second question is, someone who's just sold a house, they're thinking of either putting it in a house and saving on capital gains, but realize that house appreciation is low, selling a house is illiquid. They're also thinking of mutual fund, but they're saying, "Bhaiya, then I have to pay capital gains." Can you just give us quick pointers to
Yeah.
these two user Q&As?
Yeah. See, on the first one for tax, I think you should consult your tax advisor. Mutual funds are not tax advisors, so don't rely on. We do give on our mobile app, what's your holding period and stuff like that. But we are not tax experts, and I will not dwell into that. The only thing is that when you invest in a debt mutual fund and you go in the growth option, till you don't exit, you don't have to file for that income, because your income is recognized only when you exit. If you hold for 3, 4, 5 years, till the time you don't exit, you don't have to worry about income. You just have to show it in your capital statement that these are my assets, but there is no income coming out of it. And we normally encourage investors to look at the growth option, not take the interest option. There is no interest option in mutual funds, unlike fixed deposits. There are dividend options, but for debt, if you stay for longer than 3 years, you get benefit of indexation. Effective tax rates come down to around 7 or 8%. Versus that in fixed deposits, your effective tax rate is around 30, 35, 40%, depending on your tax slabs. So debt funds, you don't have to worry about filing your income. And I'm not the best advisor to answer that. The second one is you sold a house. My father sold a house last year, around a year and a half back. Year and a half, yeah. And the same dilemma, that do I buy another house? My answer to myself and my father when we discuss this is, if you need another house, buy another house. If you don't need another house, then just to save that incremental tax, don't lock your money again for the next 5 or 10 years, because real estate, one, is illiquid, but it has a lot of other costs. It has stamp duty, it has maintenance costs. Every month when you pay the maintenance, and when you add all of that and then take it out of the return, and then whenever you sell, you'll have to again pay tax. So my view is tax planning should always be secondary in your decision making. The first reason is that what is the need of this money? If you need this money for your long-term investments, uh, uh, then plan it differently using mutual funds. If you need a house, then of course go for a house. Now let me also give you. I live in a rented house. I have never believed in real estate in the last 10, 15 years because I always felt that in India, particularly in metro cities like Mumbai, real estate is a bubble where the place where I stay right now, Vile Parla, um, the per square feet rate is 40 to 45,000 rupees. It is the rate higher than what you get in some parts of US, in many parts of US, in many parts of Europe. For the type of infrastructure here, why should I pay 45,000 rupees? And the rental yield is 2%. If I invest in a short-term debt fund also, I get roughly around between 5 to 7%. So you are then expecting real estate prices to continue to grow, which also is challenged for a economy like ours where most of us are middle class people. We don't have that type of capital to see significant appreciation. So real estate also has long cycles of no return. A lot of people don't know that. But having said that, today, for example, after living on in a rented house for almost 12, 13 years, and now the need to work from home has gone up, I have started thinking that maybe time for me to think of a house of my own. At the same time, other asset classes are very expensive. Gold prices at a high, equity prices at a high, bond yields are low, and hence bond prices are also at a high. So for my consumption need, I need a house. Then maybe this is a good time to book your profits in equity, book your profits in bonds and gold, and then buy a house which will be yours for the next 30 years. In that case, home makes sense. But if I already have a house, I will not, invest in real estate as an investment option again.
Sure. And in your moment of truth, when your dad sold a house, you went into mutual funds. You didn't put it in another house for capital gains. So that's an
No.
interesting answer. All right. Kalpen, you're passionate, and this resonates with BankBazaar and our 50 million customers. You're passionate about a digital fund house, and that's what you've been building at DSP. Tell us, what has COVID done to that vision of yours?
I think COVID has just made us realize that how inefficient were we before COVID, and technology could have done so much more for us that we were not doing it on our own. So COVID, in a way, has acted as a great enabler to fast track the journey of digitization. So we are around 480 colleagues at DSP. 480 out of 480 are working from home for the last 5 months now, and we have been working from home almost 3 weeks before the lockdowns were announced. So technology can today enable a lot of things which we cannot even imagine. The fact that we are doing this conversation with virtually zero cost, and thanks to you, Adil and BankBazaar, I'm talking to thousands of your investors. I think the only cost is the cost of data. So it is allowing us to magnify and multiply exponentially the number of conversations and connect with our marketplace, with our partners, with our investors. Uh, uh, COVID is also making us realize that we have to be far more efficient. We have to be constantly on our toes to leverage technology, to leverage digitization, and use it as a part of our life, whether COVID is there or not there. So, in that sense, COVID has really, while it has created havoc with lives of people, health of people, money, portfolios, but it has also created a separate trend of bringing better balance in life. Realizing in the rat race, there are two ways to win the rat race. One is to quit the race. Second is to run it more efficiently. And digitally, you can actually run it more efficiently. You can do so many things more sensibly, being digital. So I think we are very excited, and as DSP, we've always had that DNA that we are a young organization. We are an organization with history and heritage, but we also have a very young team with things that today I don't need to be present in 500 cities of India if I want to serve those customers. Because if I'm present on your mobile, that's more important for me rather than having a branch in small cities. So we are very happy to leverage technology and build our business, add value to our investors. We are working a lot, saying that okay, if my branches are shut, if investors can't come and have a face-to-face dialogue, how can our mobile applications have the right conversations with investors and guide them towards understanding risk and then returns? So those are the use cases that are that keep us excited, that keep us inspired to work, and try and get better and better.
Yeah, totally resonates with what we're seeing at BankBazaar. In fact, we've seen some of our partners who've adopted to video KYC, contactless issuance. Their business has bounced back to pre-COVID levels already. And what we're seeing is now that we're using technology, right, the productivity is 20x
Yeah.
per official than what it was in a pre-COVID world, because there's no travel from place to place to
Sure.
pick up KYC. Everything is happening at one spot using video. So, Kalpen, it's been a fantastic conversation. But my last question, also, right, is a personal question. Now, all of us are going through ups and downs, dealing with things in our families personally. Some advice to us as we cope with this ongoing COVID crisis, Kalpen.
Yeah, I think I'll share a personal incident. My mother was detected positive COVID. She's 75, so we were obviously quite worried, and she had very high fever. Then we admitted her to the hospital. We got great treatment. So you realize the value of good doctors in life, and it makes me also realize the value of honest advice, because when we go to doctors, we seek a lot of honesty and trust. And likewise, when consumers, give their hard-earned money to us, they also seek a lot of honesty and trust. So to me, my first biggest reinforcement, I've always believed in this, and I worked with organizations which have also believed in this. Keep consumer first. You're dealing with investors' hard-earned money, so honesty becomes extremely important, even at the cost of growing slowly or not getting a lot of business. So you reinforce your faith in trust and expertise. So when you're dealing with your own money, look for people who you can trust, and who you believe will do good for you. Don't take things for granted. Do your homework. Number one. Number two, in the journey of having conversations with the doctor, once my mom came back home, we would, like very worried patients, keep asking that what can we do, what should we not do. And he gave one advice that COVID is a very new animal, and we are still struggling, through research and all, to figure out how to solve for it. We don't have complete answers. That's the way we actually live every day in markets. We don't have complete answers ever. Markets are always uncertain. Likewise, this COVID thing is also incomplete information. And the only advice he said I can give you is that I can't give you medicines in advance to avoid COVID. All I can say is that increase your immunity. So change your lifestyle, become more disciplined, do your yoga better, do your jalniti, do your breathing exercise, strengthen your lungs, keep a very positive and healthy frame of mind. Now, these are advices which are known to us for thousands of years in our spiritual text also, but they seem very boring. The same thing with investing. And whether it is my current 46-year-old or my past 30-year-old, the basic principles of money are: work hard, uh, earn hard, save more, spend less, and invest for long term. So these are the only things in your control. Everything else is then destiny and uncertainty of life. So like what I have learned in this last couple of months during the COVID phase is, you can't control the environment, but you can control yourself, your own behavior, your own temperament, and your own discipline. So I think if I have to summarize everything in one word, it is discipline. Become more disciplined. It will help us navigate the health challenges we are facing. It will help us navigate the money challenges that we generally always face in life. Uh, Poor discipline is equal to poor returns. Great discipline is equal to great returns over long periods of time.
Great. So, Kalpin, with that, I think we're at the end of this discussion. I want to thank you for your time. And I think what I enjoyed most, in addition to how passionate you are about mutual funds and the precise answers, right, is every question you answered with a personal example of what you did at your moment of truth. So, thank you for your valuable time. For the viewers, I hope you enjoyed this. We're going to be promoting it across our social channels. Please follow the LinkedIn page. We're going to bring you industry experts directly, like Kalpen, to help you manage your personal finance through this crisis. So thank you so much, Kalpen, for your time.
Thank you, Adil. Thank you, everyone. All the best. See you.
Thank you. Bye.